for this week, all set up, fairly predictable. The Fed hikes, Yellen's last press, the ECB, the BOE do nothing. Yeah, there shouldn't be that much drama this week, aside from geopolitical, of course. I mean, I think at this point, markets are really waiting to get confirmation from tax reform / tax cuts, what that final package is going to look like. So, I believe Wednesday is when we start to get more clarity. Does the plan look more like the Senate or the House or somewhere in between? So that's the major thing we're going to be focused on this week. Chris, it strikes me of how relaxed people are about the Federal Reserve continuing to hike interest rates and the ECB potentially stepping back through 2018 as well.
Well, if you look at it, a lot of people haven't lived through a 100 basis point tightening, and we haven't had a 100 basis point tightening in a long time. So 25 basis points at a clip, it's really nothing to be concerned about. It's nothing that I would say is very onerous. And then when you look, we're going to have a transition. And in that transition, Powell can't come out swinging. He's really got to have the confidence in the marketplace. So I don't expect anything very hawkish in the near term.
Savita, just to cross over to you, is the Federal Reserve on your agenda in any significant way at all as you look out into 2018?
Yeah, I mean, I think the appointment of Powell is comforting in that he's seen as more continuity of Yellen. What I worry about, though, is that, I guess the outside risk for next year to us is the risk of potential inflationary shocks, because that to me seems like the only thing that would hasten the course of the Fed in what looks to be an otherwise fairly a continuous fashion from what Yellen started. So I think that's the indicator to watch, as potential signs of more inflationary pressure than what we're expecting.
Chris, looking out into next year, I was looking through Barron's over the weekend, as I'm sure many of you did, and pretty much every prediction for next year was yields higher, right, equity markets higher, right, no one calling for a lower multiple, no one really cautious about what high yields would ultimately mean for the market. Is it something you think a little bit more about?
Think about it all the time. So as we look across the capital markets, everything's expensive. The 10 years at 2.3, 2.4, investment grade credit spreads 100 basis points over. You tack on a healthy 3% risk premium, you're looking at mid-single digit returns. When we look at Fed tightening cycles, what we've seen is EPS usually peaks, EPS growth usually peaks, the curve flattens, and we do see multiple compression. And that's something that we're thinking about, talking about next year. That will be somewhat mitigated by the tax situation, but we do think that multiples will compress and volatility will start to normalize.